Welcome to the Deep Dive. We're tackling Mark Larson's 12 simple technical indicators that really work today. It's a book from 2007.
That's right. And our mission really is to dig into his core principles, how these technical tools can maybe give you a better feel for stock market movement.
Exactly. Trying to understand his key indicators and, how he uses them. We're hunting for signals, not just making guesses.
Precisely. Larson's book, it aimed to sort of simplify things, focus on indicators he found reliable through his own trading starting back in '98. He saw booms and busts.
So it's coming from a practical place, not just theory.
Very much so, a hands-on perspective.
Okay, so right off the bat, a core idea from Larson is about timing. He believes technical indicators are more important than fundamentals for figuring out when to buy and sell.
That's a big claim. Basically, technicals tell you when.
Yeah, it's a fundamental split, isn't it? You've got fundamental analysis looking at the company itself, profits, management, all that.
Right, the intrinsic value stuff. But Larson says, look, focus on the price action, the volume, what the market is actually doing.
He argues those technical signals are the best guide for timing your trades, no matter how good the company looks on paper.
Exactly. When to pull the trigger.
Now, he has this great analogy about parameters. It's like baking a cake, he says.
Ah, yeah, I remember that.
If you mess up the ingredients, the amounts, you get a bad cake. Same with indicators. The right numbers, the parameters, are critical.
Absolutely crucial, especially because market conditions change, right? Bullish, bearish.
The parameters need to fit the environment.
That's it. A parameter is just that specific setting in the calculation, and Larson really hammers home that they aren't one size fits all. You got to find what works.
Finding the right parameters is kind of the quest.
It really is.
And he groups these indicators into two main types,
Mm-hmm.
leading and lagging.
Mm-hmm. Leading ones try to signal before the price moves. Lagging ones confirm a move already happening.
So his examples of leading indicators were time-segmented volume TSV, that's proprietary, right?
Yeah, TSVA, and also money stream and balance of power, or BOPA. Those try to give you a heads up.
Lagging indicators then follow the price, offering confirmation.
Right. Leading is about anticipating. Lagging is about confirming the trend. Larson definitely seems to value those leading signals, trying to get ahead.
Okay, let's dive into some specifics, starting with maybe the most basic one, volume.
Yeah, volume. Larson says it usually follows the trend. Prices go up, volume tends to increase. Prices go down, volume often decreases.
That suggests a healthy, confirmed trend, like the market's backing the move.
Exactly. But what's really telling is when it doesn't follow.
Ah, okay, like what?
Well, if the price is dropping but volume increases, that's really bearish. It means sellers are enthusiastic, right? Lots of conviction on the way down.
Makes sense. And the opposite, high volume on a price increase.
Very bullish. Shows eager buyers piling in, strengthening the upward move. He even mentions that significant volume often means, like, higher than the average of the last 20 trading days.
Right. And it's interesting, his own story. He started buy and hold in real estate.
Yeah, then shifted to active trading with technicals and stocks around '98. Said he learned the hard way about timing after some real estate downturns.
So that personal experience really fuels his focus on when to act.
Definitely adds weight. He's talking from experience, not just theory. Realized even solid investments benefit from understanding market timing.
Okay, moving averages. These are super common. How does Larson frame them?
Pretty standard definition. The average closing price over a set period, like a 30-day or a 200-day moving average.
It smooths out the daily noise, yeah. Gives a clearer trend picture.
Exactly. Filters the chop. He notes the 30 days often used for shorter-term signals. Price above it, potential upside. Below, potential downside.
And useful for support and resistance levels, too.
Yeah, definitely. He even mentions placing stop losses just below that 30-day MA sometimes.
And the big one, the 200-day.
He sees that as the major line in the sand. Strongest support or resistance. A break above or below that is often a big deal. Market really watches it.
It's important to remember what it represents, though. A 7-day average is the average price over the last week of trading.
Right. It's the collective action over that period, just smoothed out.
He also distinguishes between simple moving averages, SMAs, and exponential ones, EMAs. He leans towards simple.
Mostly, yeah. SMAs react slower, which he thinks gives more reliable signals for his methods. EMAs are faster, react more to recent prices. He finds them less effective generally.
Except maybe with certain specific indicators he mentions later.
Exactly, but his main focus is simple moving averages.
And the lengths people use have changed too, haven't they?
Yeah, he mentions back in the late 90s, shorter ones like 10-day, 20-day were popular for quicker signals. Now some traders go even shorter.
Which brings us to crossovers, like a short-term average crossing a longer-term one.
Right. Larson talks about the 10-day crossing below the 20-day. That could be an early sign of weakness, maybe a short opportunity.
And the opposite, 10-day breaks above 20-day, a potential buy signal, strength coming in.
Potentially, yes. Think of them as early whispers. But they need checking.
Confirmation is key then.
Absolutely. Larson stresses looking for confirmation for at least 3 straight days after a crossover. Helps filter out false signals, that noise.
And again, patience with that 200-day MA. Wait for a clear break below for a stronger short signal.
Right. Don't jump the gun just because a short-term crossover happens near it.
He also mentions gaps, those overnight price jumps.
Often due to news. He notes down gaps can be particularly negative signals, often leading to further declines, like the market opens with bad news baked in.
It shows how technicals interact with real-world events.
Definitely. Gaps are powerful signals of rapid sentiment shifts.
Now, his 12-plus system, what's that about? Sounds like his personal setup.
It is. He uses 12 charts, or tabs, each with indicators he ranks. More pluses, more indicators giving a positive signal, increases his confidence for a trade.
So it's about getting agreement across different tools. Confluence.
Exactly that. Building a stronger case by seeing if multiple different indicators are pointing the same way. Reduces reliance on just one signal.
He also applies moving averages to volume itself.
Yeah, that's interesting. If daily volume spikes above its own moving average, say a 20-day average of volume, he sees that as a possible early sign of a breakout.
How much of a spike?
He likes to see daily volume hit at least 1.5 times its 20-day average. Suggests strong conviction behind the move.
Ties back to volume confirming price then.
Precisely. Makes the price move seem more legitimate, less likely to be just random fluctuation.
And fundamentally, it all comes back to supply and demand, right?
Yes.
Moving averages just help visualize that battle.
That's the underlying driver. Buyers versus sellers. The indicators are just lenses to view that dynamic.
Okay, let's switch to balance of power, BOP, one of his leading indicators.
Right, BOP. This one tries to gauge if the big institutions, the whales trading 10,000 shares or more, are systematically buying or selling.
Focusing on the big money flow.
Exactly. Their actions can really move markets. BOP is plotted around a zero line. Above zero suggests institutional buying pressure.
Below zero, selling pressure.
Yep. And around zero often means things are pretty neutral, maybe moving sideways.
He talks about a bullish BOP. That's when institutions start accumulating stock.
That's the idea. And he suggests looking for a moving average of the BOP indicator itself to cross above that zero line for extra confirmation.
A moving average on the indicator, not the price.
Correct. He calls a shift from bearish to bullish BOP, or vice versa, a change of character. Signals a potential change in who's driving the market.
And which moving average does he use for that BOP confirmation?
He mentions using a 12-day simple moving average on the BOP. Says he found that time frame works well for him.
Okay. And a bearish BOP. Institutions are selling, maybe with higher volume.
That's the signal. Big players liquidating positions. Combined with rising volume, it can be a strong warning sign for potential drops.
Now, this BOP divergence idea sounded really interesting. Price goes up, but BOP shows institutions are selling.
Yeah, he flags this one strongly, sees it as a potential warning. Like the market, or the exchange as he puts it, might be tricking retail investors into buying high.
While the big guys are quietly getting out. Wow.
It highlights that disconnect sometimes. Retail optimism pushing prices, while institutional money acts differently. He advises real caution there.
Definitely something to watch for.
For sure.
Then there are bullish and bearish groupings. This involves the moving averages themselves.
Right. The 20-day, 50-day, and 200-day moving averages, when they all converge really tightly together.
Like they're bunched up.
Exactly. He sees that as pent-up energy. Suggests a big move is coming, up or down. Other indicators then help guess the direction.
And if all three actually touch?
He considers that a very strong signal of an imminent major move. Says he actively scans for that pattern, like a coiled spring ready to release.
Okay, interesting. Let's talk Ameki. Moving average convergence divergence.
Magsy. He claims a very high success rate, like 90% when you use it with PRC, price rate of change.
That's a bold claim, 90%.
It is. shows how much faith he puts in that combo. And Maggie is different. It uses exponential moving averages, not simple ones, usually 3 of them in the calculation.
So it reacts faster to recent prices.
Generally, yes.
Yeah.
Gives more weight to recent action.
Now, for signals, he looks beyond just the standard MAGA line crossovers.
He does. He watches for when the 3 underlying EMAs themselves get really close together convergence. He says an actual crossover is stronger, but even just touching or being super close.
Like an eighth of an inch close on the chart.
Yeah, that close. He sees that as significant.
And he prefers the histogram version of Maggie.
Right, not the lines. He finds the histogram clearer for spotting that change of character, the shift from bullish to bearish momentum or back again. The bars give a more visual feel for it.
Okay, let's unpack the other half of that combo. Price rate of change, PRC.
PRC also gets that 90% success rate claim when paired with MACD in his view. The key parameter he uses is 21 days.
How does that calculate?
It's the current closing price divided by the closing price from 21 trading days ago.
Simple enough. And the signal.
The crucial thing is you need both the stock's price and the 21-day PRC indicator itself to cross the 50% level. Both above 50% is bullish, both below 50% is bearish.
Need both confirmations.
Yes, not just one or the other.
And using a shorter PRC, like 15 days.
He suggests that AGA can sometimes give an earlier warning, a bit more sensitive, maybe catches turns slightly sooner.
Shows the value of playing with parameters again.
Absolutely. Different time frames offer different perspectives. Early warning versus stronger confirmation.
Larson really pushes acting on these signals, even in, say, retirement accounts you plan to hold long term.
He does. Suggests a monthly checkup. Says it only takes a couple of minutes per stock with a good system. For mutual funds in those accounts, maybe look at longer charts, like 5-year ones.
That's practical. Don't just set and forget completely.
Right. Even long-term holdings can benefit from checking if the technical picture has drastically changed. The longer view for funds makes sense too. Less volatility, usually.
And PRC isn't just for buying. Good for shorting signals, too.
Yes, he mentions using it for identifying short opportunities. But he strongly emphasizes if you short, you must know when to cover, when to buy back, and close the position.
Exit strategy is critical for shorts.
Absolutely essential. Losses can run away from you otherwise.
Okay, time segmented volume, TSV. This is proprietary to Worden Brothers TC2000 charting.
That's right. He mentions being a longtime user thinks highly of TC2000. He calls TSV a leading indicator because it mixes price movement and volume data.
Trying to get ahead of the price move again.
Exactly. And he finds entry-exit points often show up when the TSV line crosses at the 0 level, which he also calls the 50% level.
What parameter does he use for TSV?
He settles on an 18-day parameter for his own TSV calculations.
But again, never just one indicator, right?
Never. He's very clear. In his 12-tab system, he wants confirmation from at least 7 different indicators before trading. He mentions TSV is on tab 11, suggesting it's one he uses later for stronger confirmation.
That multi-indicator approach seems central to his whole method.
Definitely. It's all about increasing probabilities by looking for agreement across different tools. No magic bullet.
Let's talk RSI, Relative Strength Index. That's a classic. From J. Wells Wilder Jr.
It is. RSI compares recent gains to recent losses over a period. Generally seen as a lagging indicator, confirms trends.
But Larson combined it with TSV, creates something new.
Yeah, he calls it RSI TSV. He found combining them makes it much more powerful for him.
How does he use RSI TSV?
He uses 3 different parameter settings for it. And the main signal is when the RSI TSV line crosses its own center line. He claims this combo signals good trades about 90% of the time.
Another 90% claim. Seems he found some combinations he really trusts.
It seems so, but again, he stresses patience. Wait for that centerline cross to get the reliable signal. He admits he struggled with standard RSI alone, but adding TSV made it work much better for him.
Shows how traders adapt and combine tools.
Exactly. Finding synergies. Sometimes 1 + 1 equals more than 2 with indicators.
Okay, next up, inertia. He calls this an ultimate favorite.
Yeah, borrowing from physics. Measures momentum based on volatility on a 0-100 scale.
So below 50 is negative momentum, bearish or neutral.
Correct. And above 50 is positive inertia, bullish. He calls it a confidence builder.
But the price needs to agree.
Yes, that's key. The stock or index price should be trending the same way as inertia when it crosses that 50 line. He uses parameters 10, 14, and 20 for it.
He gave that example from 2007, didn't he? Inertia turning bearish on the Dow before a big drop.
He did. Suggested it could have helped avoid that downturn. And then it turned bullish again before a later rally, showcasing its potential predictive power.
Helps avoid getting caught on the wrong side of big moves, potentially.
That seems to be how he uses it, as a confirmation and confidence tool.
All right, last indicator. Average true range, ATR. This one's about volatility.
Yes, ATR measures volatility. It averages the true range of prices over time. True range considers the day's high-low, but also gaps relative to the previous close.
What parameter does he use?
A 15-day parameter. He says it basically tells you the stock's average daily travel distance, how much it typically moves in a day.
And its main use for him is setting stop losses.
Primarily, yes. His rule of thumb: take the current ATR value, double it, and set your stop loss that much below the current price for a long trade.
So if ATR is $1, you set the stop $2 below the price.
That's the idea. And importantly, adjust that stop daily or weekly as the ATR itself changes. Volatility isn't static.
And ATR readings themselves can tell a story. High ATR at bottoms.
Yeah, high ATR often comes with panic selling at bottoms. Low ATR tends to happen during quiet, sideways markets. He thinks ATR helps avoid setting stops too tight, getting shaken out by normal noise.
Prevents getting stopped out just because the stock had a typical volatile day.
Exactly. Gives the trade a bit more breathing room based on its actual volatility.
Okay, so after discussing all these indicators, he talks about stock scans, automating the search.
Right. Using software to find stocks that meet specific technical criteria, combinations of indicators and parameters, like a recipe.
A technical recipe to find stocks that fit your criteria.
Precisely. You can build scans for bullish conditions, bearish conditions. Saves a ton of time compared to manually checking hundreds of charts.
How many criteria does he suggest using in a scan?
He recommends using at least 6 or more technical ingredients to get a focused list. Really narrows it down.
But scans just find candidates, right? They don't give the exact buy-sell signal.
Correct. They identify stocks worth analyzing further. You still need to do the detailed technical analysis on the chart to find the precise entry and exit points. They filter, they don't trade for you.
Helps avoid that analysis paralysis, though. Gives you a manageable list.
Definitely. Focuses your attention where it's most likely to yield results based on your strategy.
And finally, he boils strategy down to some simple ideas.
Very simple. Buy stocks going up based on your technicals, short stocks going down based on technicals, or use basic options like calls for upside, puts for downside.
He implies complexity often comes from a lack of faith in the technicals.
That seems to be his view. Keep it simple, trust the indicators you've chosen, and understand. Let the technicals guide the direction.
So wrapping this up, the big takeaway from Larson seems to be that technicals, if you understand them and their parameters, really can offer useful insights.
Yeah, insights into trends, potential turning points, opportunities. It's about using them thoughtfully with confirmation.
And remembering this is his perspective from back in 2007. Markets evolve, but maybe the core principles still hold value.
I think so. Focusing on parameters, leading versus lagging, using multiple indicators for confirmation, those ideas are pretty timeless in technical analysis.
Hopefully, listening to this, you might look at charts a bit differently now. Maybe notice the volume more, or how those moving averages are interacting.
Yeah, maybe see things you didn't notice before.
Which leads to a final thought for you, the listener, to maybe chew on.
Okay.
How might adding even just one or two of these simple technical indicators change how you understand market action or financial news?
And following on from that, based on what you heard, what parameters might you even start thinking about exploring? Depending on your own goals and how long you tend to hold investments.